Good morning. It's May 10th, 2023. And you might be like our team, rolling short-term treasuries for the past year, holding them to maturity and picking up some nice yield. But we all know that sometimes you want to go out in the curve, especially when central banks may be at least heading for a pause. And then yield curves are going to move from inverted to steepened, even if the entire curve moves down. So how do we balance the timing of this move, especially when there's a lot of macro data still coming out? We've got that debt ceiling impasse going on that if, by small chance they didn't get a deal done, obviously we think that rates would jump. People would be very concerned. So how do we solve that? By legging in. So as you set the total amount you might want to allocate to the exposure, think about putting some of it to work over time. Most likely your first purchase is going to be early, although you'll be glad you started early if they're not, and the position gets away from you. But when timing can't be perfected, which is most of the time, that's the approach we tend to take versus an all-in, all-out approach, because then you really have to get that timing right. We were on with one of our primes today and having this discussion as well as other fixed income related discussions like what are the pitfalls of shorting high yield at this juncture, which we haven't done, but just talking about a variety of topics. And, we talked about how none of us believe in the 50 to 80 basis points Fed cuts this year. The reality is that the market will look ahead to cuts when the Fed is pausing. And that's really the river card of June, right? At the same time, make no mistake that if we don't solve that debt ceiling impasse, treasury yields are going to go up. And so will all debt priced off of it. So there's event risks involved here when you're thinking about timing. So whether you can research and invest in a basket of bonds or take a position, be an equity ETF that tracks fixed income securities like the TLT, IEF, zeros, whatever you want to call it in terms of the duration you're looking at, the Longbow platform can be helpful with short-term timing and understanding the trends. So let's take a look at a few securities I loaded up for you this morning. I'm giving you the short end, so the 1 to 3 year Treasury ETF via SHI, that call it middle 7 to 10 year Treasury ETF IEF, the 20 plus year TLT, and then also I gave you high yield just to show you. And they're all sitting in the middle end of the range, but you have really different momentum going on. So you've got neutral here on the short end, medium end, bearish still in the long end, and then high yield is neutral. And then you've got a bullish medium term. So I want to pick off the IEF because that might be where some of the more interesting returns can come from this year. We're sitting at the middle end. We've had a narrowing of the range. This security has been, slightly bullish since October, as people have thought that maybe we're nearing the end of hiking. So we would look, if you're looking at this security, to be waiting till you hit the low end of the range. It's got a beta of 1. So interestingly, because of last year when bonds traded like equities, we think this will change. This will change now that we don't have that big hike in rates alongside a surprise from low rates to high rates, as inflation is at least staying more sticky, not accelerating in terms of growth. You've got a really low short interest rate here, so it's not like you're going to get a pop because people are short the security anymore. And then let's take a look at the odds. So in the IEF, it's basically in the middle, 1 down to 1. So you're in the middle of the range, 1% upside, 1% downside, and signaling a neutral, obviously. So you're going to be watching when this gets to the low end of the range. That's when you might want to be picking up. If you're looking into more risk and you really believe the rates aren't going up, obviously you want to go further out in the curve, so longer duration treasuries. And then if you think that their Fed's going to pause or pivot this year, the short end is obviously where they're going to have more impact. We're not in that area where we'd rather just own shorter term treasuries and hold to maturity. That's what we'd be doing when rolling. But I just wanted to give you a few of the tickers you could put on your screen to be watching. That's it for today, and we'll catch you back tomorrow.